Welcome to Stocks in Translation, our essential conversation cutting through the mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. Today, I'm joined by our intrepid producer, Sydnee Freed, along with Peter Borish. He is the Chairman and Chief Executive Officer of Computer Trading Corporation. Also spent 10 years, a decade with Paul Tudor Jones at Tudor Investments. We're going to get to the markets in a second. Just a quick hello from you.
Thank you. It's a pleasure to be here, and it's really an honor to get through the noise instead of just talking about today.
I appreciate that, and we're gonna cut through a bunch of noise here. Today's theme is past as prologue. We're gonna be stitching together pieces of market history to assess what's rhyming and what's different this time. In our phrase of the day, arguably the most important concept in investing, risk management, what it means in today's trading environment. And this episode is brought to you by the number 7, as in the 7 C's of commodities. It's not just corn and cocoa. All right, Peter, Sid, first story of the week. We have the major indices, that would be the Dow and S&P 500, the NASDAQ, back to record highs just about. Jobs in focus this week. Next reading on inflation is next week. But we've been here before, so just set the table for us, Peter.
Well, as I said, thank you. So my position has always been since 22 that the most popular job on Wall Street is every 3 months, forecasting that the Fed is going to cut in 3 months. So we had January, they're going to cut in March. Then in March, they said they're going to cut in June. And now we're in June, and they're going to cut later on in the year. There's a lot of cross currents going on. That's why I look at those 7 C's, from crude to cocoa, to give a sense of where we are and what interest rates are potentially going to do.
All right, and let's dig into that a little bit. What are you seeing specifically? I mean, it's funny, you mentioned that every 3 months it seems like everybody's predicting that rate cut 3 months away. A couple of years ago, everybody was saying, well, the next recession is 2 years away. We've come a long ways from that, but there's a cyclicality to monitoring the business cycle itself. Is there any surprises to you now, or you think you've seen it all?
There's always surprises. That's the beauty of markets. But if I can steal a line from my old boss, Paul
Please.
Jones, which you kindly introduced, he has a sign behind his desk, which is, what is obvious is obviously wrong. So last year was totally obvious that we were going to have a recession. That didn't happen. This year was totally obvious we were going to have 6 interest rate cuts. That didn't happen. This is a business where your word of the day, risk management, is critical. We can gossip all we want, but when it comes to trading, you have to have a defined methodology and a point at where one is going to be wrong. So if we look at Friday, it's like, woo, as you said, the market's going to new highs. It was great. The Dow was up. Now we're here 4 hours later in trading, and now the market's down. So we are basically in this sort of tug of war until we get more data, rats on a ship. We're all running to one side thinking it's going to capsize, and then when it doesn't, we're all running back to the other side. And it's a bit frustrating as a trader if you're sort of a long-term investor and you're not looking at these things. You're like, who cares?
Yeah. So Peter, how do investors, especially like beginner investors, cut through noise? The noise being everybody guessing us, everybody forecasting the Fed's going to cut, or even honestly, the noise after you get a big data point and then everyone's just forecasting what's coming next. How do you just cut through that and kind of hone in on the data yourself to make smart decisions?
Well, if you step back, and a lot of it depends on where you are in your investing cycle, but if you're just starting and you look back in history, it's all irrelevant. You can go back to 1929. Okay, so that was really bad. But we go back to sort of post-World War II, and you can look, we had this gigantic problem in 1962 with steel. We had 1987, et cetera, et cetera. In the scheme of things, if you believe in our markets and our policy, as we move forward, the markets should go higher. The question one has to ask themselves as we're going into such a conflicted year, are those policies going to continue? And that, again, becomes a risk management conundrum.
Let me ask you about 1987. You just mentioned that famous for a crash that happened this year, and PBS filmed a documentary of you working alongside Paul Tudor Jones, and you guys called it in real time. As in, with anything in trading, nothing's perfect, but there were some rhymes. You were looking at the past as prologue. You were looking at some other crashes throughout history, and you saw the analog. Can you describe what that was like, just kind of living through that?
Yes, and thank you for that. First of all, we were a lot younger, and I think that part of your risk tolerance is a little higher when you're younger, and maybe a false sense of confidence as well. So when I built this model, we had a lot of confidence in it. But the major thing that distinguished us, and it's not dissimilar for today, is that Paul was willing to invest a lot of money in data and computing power.
Back when it wasn't done that much.
That's correct, and it was expensive, right? Data was expensive. We had people, they had us hire summer interns and get books out of the library and put them in spreadsheets. There wasn't like today where you can go on a website and download the stuff in hundredths of a second. So there was that commitment, and then there was the notion of following the model, and as the model unfolded and had more correlation with what we thought was going to happen, it gave us better confidence. But at the end of the day, we can't take away from the fact that Paul was a great trader.
Instinctual-wise.
Well, he had a game plan, and he stuck with it. And I always said, if I could pick the exact low and the exact high, which generally speaking, I do the opposite a lot better, he'd still make more money because markets don't go in a straight line. And what we had there, and it's a little bit of concerning today, we're nowhere near set up for any type of crash or anything. I just want to make that clear.
Thank you.
Is that we had new financial products. In the case of financial futures were only 5 years old. There was new ideas like portfolio insurance, and they weren't really fully integrated. And it's like when you have a young child and they're 5 years old and you can talk to them and you think they understand you and they're going to behave, but
they got their own
not.
agenda.
They're not. And so there's a lot of new financial products out there recently that have the potential to cause havoc that we haven't seen yet. And by the way, when we saw problems in 98, in 99, 2008, 2009, a lot of that had to do with misunderstanding the full amount of leverage that was embedded in new financial products.
So, you just said we're not facing a risk of a market crash right now. We're not in the same as the 80s. But what are some of the problems from back then that kind of remind you of where we are now?
Yeah, these new products.
These new products, yeah.
So there are some new products. I think you have to take into account the products, the political environment, and the economic environment, and all three of those together. So some of the products one can talk about now are zero-day trading options, right? Are they embedded? What's the gamma if there's a big move, and is that going to push things? Because gamma is always a problem. The huge growth in private credit, so there's less transparency in the marketplace. In global macro structure, I don't need to tell any of your audience of what's happening around the world. And we've seen that obviously in Israel with the tragedy there, with Russia and Ukraine. So when you think about the United States government, what is it? It's essentially an insurance company with a military. Medicare.
Let's think about that 1 second. An insurance company with a military, the U.S. government. That's a powerful statement.
Because Social Security and Medicare and our military, which given the uncertainty, that spending is not going down. Social Security, Medicare is not going to be cut. You can cut the rest of the spending, it's a rounding error. So if we don't address our fiscal issues, then the likelihood of interest rates going higher are very significant. And interest rate cycles, you talk about the crash, you talk about that period, are very long. And I don't mean to be getting on a tangent, but this is...
That's what we're all about here. We love rabbit holes.
This is a cut through the noise show. So if we think about that, from World War II to 1982, interest rates went up. And by the way, Nice 38 years, 44 to 82. And like most markets, the biggest moves happened at the end, 80 to 82. We then had, shockingly, a 38-year decline in interest rates from 82 to 20. And when was the biggest move? The last 2 years. So now we are just in the very, very early stages, in my opinion, of a longer-term rising interest rate cycle. And if we don't get our fiscal house in order, and that has nothing to do, in my opinion, with spending, because it has a lot more to do on the revenue side. So hypothetically, if the Trump tax cuts are not repealed, I will say here today that I think the 10-year will be going more towards its longer-term median, which is somewhere around 6.5%. And that is not going to be good. So for everybody that's concerned about their tax rate, they're going to lose a lot more money because of the pressure that's put on markets and put on housing and put everywhere else if interest rates go up a lot higher than people think. Now, we know we anchor to past prices. This is the fallacy of trading.
Yeah,
right?
well, I mean, market anchors are what, kind of a fundamental bedrock of technical analysis.
We think, oh, the market was here, it came down, it has to go back to new highs. There's no law that says that. Or if you're short, vice versa. If it was down there and rallies, and it's the same thing. So we're so mentally used to having interest rates decline, that's all we think about. And we put them on a pedestal, all the Fed economists. And by the way, right, that's where I started my career.
You were a Fed economist in the beginning.
I was. And Wall Street is littered with former Fed economists. I think it's a great place for them to go. As we say, economics is a good job for economists. But if you're going to forecast, one should forecast often. You can't get wedded to your position. So if we go back to the markets today, and I'm leaning towards, hey, guess what? Crude is really weak. That's one C down the drain, right? Coffee strong. That's a C that's positive. Cocoa strong. But guess what? Cattle is weak. That hasn't done it. Copper's in the middle of its range. Cotton's at the lower end. So there's this cross circuit. So I'm not super positive now on the strength of the economy as I was a few weeks ago when the supply and demand was saying this. Oh, and the seventh one, of course, is corn, and that too has been weak.
I'm going to pause you there and really appreciate you getting to the 7 C's there. We do have to take a quick break here. We are back with Peter Borish of Computer Trading Corporation, and we're talking about risk management now. And let me just give the Investopedia definition. Risk management involves identifying, analyzing, accepting, and or mitigating uncertainty in investment decisions, so uncertainty. Put simply, it's a process of monitoring and dealing with the financial risks associated with investing. So I think there's a lot of applications of risk management to trading, to investing, but what does it mean to you?
Risk management, pure and simple from a trading perspective, means that you can live to trade another day. That I am not right, the market is right. And I always say the right to change my mind starts as soon as I put my tongue back in my mouth. Because if I buy something, I buy it because I never think that it's going to hit that low price again. Because if I did, I'd wait and try to buy it lower. The reality is you're wrong most of the time. So that's where taking risk and measuring that risk and then getting out if you're wrong permits you to do well. It's the same thing as if you're playing Texas Hold'em. It's not how many pots you win, it's the size of the pot when you do win. And that's why people who have, right, and my history being with CTAs is they're volatile per se, but they survive. And that's the whole point. If you survive, you can fight another day.
In an industry that's built on leverage, so risk management, job number one, arguably for commodities traders, but even if you're just buying stocks, you need to have that strategy in place. What I like what you were just saying is you're usually wrong. And I think this is, if I'm just looking at Twitter, the best traders, they're right 99% of the time, right? Well, no. I mean, I used to be in the commodities industry myself, and I did studies. I would read studies about traders. They're right maybe a momentum trader right 1 in 3 times. So losing is part of the business. It's kind of how you lose that really defines you as an investor, I would think.
Absolutely. I get all the time, right? People ask, oh, so tell me about trading. I'm like, trading is easy. And they go, what do you mean? I go, well, you look at the best performing stocks over the past 6 months, and then you go back 6 months and buy them. Because that's how...
Just need that DeLorean.
Yes. It's made to appear for most people. And in a lot of sense, it does a disservice. Because in hindsight, right, we can always pick the low or pick the high. But we have to deal with an uncertain tomorrow. So the further your time frame in terms of how long you want to trade, the smaller you should trade because the uncertainty is larger. So if you go back to my first example, if I'm like, okay, I think rates are going higher, bonds have rallied today, and that's it. I've seen the top tick. Now, if I'm a nut, which many people think I am, I could sell a whole bunch of bonds and risk that one tick and get stopped out. And if I'm right, I make a lot of money quickly. But what's the real probability of being able to forecast that top within a tick and say to yourself, if it goes past that one tick, I'm going to get out?
And then you got to get back in.
That doesn't make sense. Yes. And then that's the other issue. You can trade yourself to death by getting in and in and in and in and in. And if you're a discretionary trader, you also have to take into account the intellectual and the emotional.
Burnout.
And yes, too often individual traders, they think of themselves as fans, right? They're worried about the last game. The professionals have to worry about the next game. If I strike out with the bases loaded and lose the ball game, that game is lost. I've got to learn from it and move on. If I dwell on it, I'm already history.
Peter, let's talk about the early investor, because we're talking about a lot of, like you said, professional investors, maybe people who are trading stocks every day. Is there such a thing as risk management for someone who's just passively invested? You own some index funds, and you're just kind of letting them sit. What does risk management look like for those people?
Risk management for those people, and by the way, that's a really outstanding question because it's a totally different kind of risk management. The risk management for them is diversification. And trying to understand that everything going up together at certain times, which we're a little bit in now, raises short-run risk. But if you're diversified, that's okay. You're going to accept some volatility. If you're younger and investing, you have to be willing to accept the pain. And if you have to invest small enough amount that you're willing to accept that, because emotions are greater in losing, right? Everybody hates losing more than winning. In fact, if you use the economist term, right, there's the marginal diminishing utility for more money, but as a sports person, it's why coaches have to sort of take time off, because they expect to win and they don't get a lot of pleasure out of it, but the pain of losing is too much. So if the pain to a new investor of losing is too much, they have to have a smaller position.
Great analogy there. I want to get to a segment that we like to hit in the bottom half of this show. It's called Who Wore It Better? And this is now, I'll just set it up for you. We know that in Hollywood we have these various gossip shows, and they have a Who Wore It Better. Somebody might be wearing the same dress to different galas, but here, we're going to extend this metaphor. We have the Securities and Exchange Commission. We have the Commodities Futures Trading Commission, SEC versus CFTC, both regulators, one of stocks, one of futures. We have Gary Gensler. He's the chair of the SEC. Over at the CFTC, there's Chairman Rostin Benham. And the CFTC is admittedly smaller. It doesn't get as much play in the media just because of what it oversees. But I'm wondering, who's wearing the current regulatory regime better right now? Is it the SEC or the CFTC?
Thank you for asking that. I am a strong CFTC proponent. They historically have been the innovators of financial markets in the United States, going back to 1982 with the introduction of stock index futures. The SEC is more regulatory minded, and in the sense that they are a little bit more paternal. So if you take this early investor, which is kind of strange, right? So there's this a little bit of arbitrage. I can go on an online account and I could take a whole bunch of risk. But if I want to invest in an LP through a regulated
Limited
SEC, then all of a sudden I have to be rich to do it. So if I'm not rich, I can take a lot of risk through online brokerage firms, but I can't take the risk of investing side by side with me or with you. And the CFTC has always been historically more pro-innovative than the SEC.
Well, I'm glad we went there. Sid, I could tell you had perhaps a burning question. Maybe
Burning question.
Okay.
It's a personal one, though.
Oh, even better. Burning personal question.
Okay.
So I hear you've been a Knicks season ticket holder since like 1991. I'm going to ask you, we're talking about alternative investments here.
Okay.
Athletic tickets. Has that been a good investment for you over the last 3 decades?
Well, it's been emotionally tough. It's like having a losing position on in the markets. And when you go back and I measure it through, so my first child was born in 1991. So
Nice.
to grow up and have those family togetherness is really, really special. To watch Reggie Miller do what he did in 1994 after the fact is special. To see the pain of Game 7 of this year. But the beauty of sport is watching it live, whether you're there or whether it's on television. And it's in this polarized world that we're in, professional sports in general are the one place where people come together and are rooting for a single jersey, in this case the orange and the blue, for the Knicks, and they're putting all their politics aside. To me, that's great and healthy.
That was a very touching answer, I have to
thank you.
say. Yeah.
Wasn't expecting that. We got 90 seconds to go. Real quick, anything we didn't touch on here? Anything that you'd like to communicate to the investing crowd here?
Yeah. One, do your own homework. That's the most important thing. There are no shortcuts. And luck is not a strategy, which is why our word of the day, risk management. It's good to be lucky, but it's better to be lucky and good.
All right. I lied because we actually have 1 minute left here. I want to get your thoughts, quick thoughts on Jim Simons, Renaissance Technologies founder, died. Just incredible returns, double-digit returns for decades over the years. Why do you look up to him?
Well, first of all, it's sad, and I had the honor of, and still do, of being on the board of Math for America, which he founded.
Yes.
And I actually am chair of the audit committee, and I told him, I said, you know, Jim, if you think you have enough confidence in me in numbers, that's a good thing, because in the history of the world, very few people have math theorems named after him. By definition, much fewer were alive. And I said to him, Jim, I can't even understand the title of your math theorem, so you have my utmost respect.
And that's coming from somebody very tech-oriented himself. We got to wind things up here. Peter, thank you for joining us today. Sid, as always, keep your dial locked to Yahoo Finance.